If you are currently walking around with a debit card in your wallet, you are voluntarily playing the financial game on hard mode. In fact, you are doing something reckless. Every time you swipe that piece of plastic, you are exposing your direct bank account to the world. You are earning zero return on your spending, and worst of all, you are telling the banking system that you do not matter. I am going to say this once. Rich people do not use debit cards. Wealthy people do not pay for things with their own money until the very last second possible. They use the bank's money. They use leverage, and they get paid to live their lives. Today we are going to dismantle the way you look at plastic. We are going to move you from the consumer mindset, where debt is scary and debit is safe, to the investor mindset, where credit is a tool, points are a currency, and an 800 credit score is the key that unlocks cheap capital for business and real estate. We have a lot of ground to cover. I'm going to break down the exact mathematical structure of credit scores, the utilization hacks that 99% of people miss, the difference between toxic debt and powerful leverage, and how to structure your profile so banks beg to lend you money at prime rates. Let's start with the fundamental contrast: the world of debit versus the world of credit. When you use a debit card, the transaction is immediate. You swipe, money leaves your checking account, it is gone. If a skimmer at a gas station copies your card numbers, the thief is draining your liquidity. That is your rent money. That is your grocery money. You have to call the bank, file a fraud claim, and wait. While you wait, you are broke. The bank will eventually fix it, but the stress is yours. The liability, effectively, feels like yours. Now look at the credit card. When I swipe a credit card, no money leaves my account. The bank pays the merchant on my behalf. I have effectively taken a short-term, zero-interest loan for 30 to 50 days. If a thief steals my card info and buys $5,000 worth of electronics, guess whose money is missing? Not mine. The bank's money is missing. I get a notification, I click "This wasn't me," and I go on with my day. The bank fights to get their money back. I am insulated from the risk. But security is just the baseline. The real issue is opportunity cost. If you spend $3,000 a month on life, groceries, gas, insurance, dining, and you do it on a debit card, at the end of the year, you have spent $36,000. What do you have to show for it? Nothing. If I spend that same $36,000 on the right credit structure, I have earned anywhere from 2 to 5% back in value. That is roughly $700 to almost $2,000 in free travel or cash. But more importantly, I have built 12 months of payment history. I have shown the system I can handle leverage. I have increased my creditworthiness. You have remained invisible. So, step 1 is a behavioral shift. Put the debit card in a drawer. It is for ATM withdrawals only. Everything else goes on credit. But here is where people get scared. They say, "But I don't want to go into debt." This is the distinction you must understand. Using a credit card is not the same as carrying credit card debt. I am not telling you to spend money you do not have. I am telling you to spend the money you do have, but through a different vehicle. You treat the credit card like a debit card. You pay it in full every single month. If you cannot trust yourself to do that, stop listening right now. This strategy requires discipline. But if you can control your impulses, the system is rigged in your favor. Let's go deep into the mechanics of the credit score. Most people think it is a random number. It is not. It is a formula. And once you know the variables, you can manipulate the output. The FICO score ranges from 300 to 850. We are aiming for anything over 760. Once you cross 760, you effectively have perfect credit in the eyes of a mortgage lender or a business underwriter. And 850 is a vanity metric, but 760 is the financial floor we want to stand on. Your score is broken down into 5 categories. Category 1, payment history. This is 35% of your score. It is the biggest chunk. This is binary. Did you pay on time or did you not? One late payment, 30 days past due, can tank your score by 100 points instantly. It stays on your report for 7 years. This is why you set up autopay for the minimum amount on every single card you own. Even if you plan to pay it in full manually, the autopay is your fail-safe. It prevents a catastrophic error. Category 2, amounts owed. This is usually called credit utilization. This is 30% of your score. This is where the game is played. This is where most people fail without realizing it. Utilization is the ratio of your balance to your limit. If you have a $10,000 limit and you have a $5,000 balance, your utilization is 50%. This screams high risk to the algorithm. Here is the secret. The credit bureaus do not know if you pay your bill in full every month. They only see the statement balance. Let me explain the timeline because this is critical. You have a billing cycle. Let's say it runs from the 1st of the month to the 30th. On the 30th, the cycle closes. The bank generates a statement. That statement says you owe $2,000. That number, $2,000, is what gets reported to the credit bureaus. Then you have a due date, maybe on the 25th of the next month. You pay it off then. To the bank, you are a perfect customer. You paid in full. But to the credit bureau, for that entire month, it looks like you are carrying $2,000 of debt. If your limit is low, your utilization looks high. Your score drops. To hack this, you need to pay your bill before the statement cuts. 3 days before the cycle closes, log in. Pay the balance down to almost zero. Leave a tiny amount, maybe $10, or pay it to zero. When the statement closes, it will show a balance of $0 or $10. That is what gets reported to the bureaus. Your utilization is near 0%. Your score rockets up. This is called the ASIO method. All 0 except 1. If you have 5 credit cards, you want 4 of them to report 0 balance and 1 of them to report a tiny balance, less than 1% utilization. This maximizes the algorithm. Category 3, length of credit history, 15%. This is why you never close your oldest credit cards. Even if that first card you got in college has no rewards and is terrible, keep it open. Put a small subscription on it, like a streaming service, and set it to autopay. If you close it, you amputate the tail end of your history. Your average age of accounts drops. Your score drops. Category 4, new credit, 10%. This is hard inquiries. Every time you apply for a loan or a card, the lender checks your report. This is a hard pull. It dings your score by 3 to 5 points. It is temporary. It bounces back in a few months, but you do not want to look desperate. If you apply for 10 cards in a month, you look like you are in financial trouble. However, there is a nuance here. If you are shopping for a mortgage or an auto loan, all inquiries within a certain window, usually 14 to 45 days, count as one inquiry for scoring purposes. But for credit cards, each one counts. Category 5, credit mix, 10%. Lenders like to see you can handle different types of debt. Revolving debt, which is credit cards, and installment debt, like a car loan or a mortgage. You do not need to take out a loan and pay interest just to help this part of your score. But it explains why paying off a car loan sometimes causes your score to drop slightly. You lost an active installment line. Do not worry about it. Now, let's talk about the specific leverage of high limits. You want high credit limits, not so you can spend more, but so your natural spending represents a smaller percentage of your limit. This is the denominator effect. If you spend $5,000 a month and your total credit limit is $5,000, you are at 100% utilization. Your score is trash. If you spend $5,000 a month and your total limit is $100,000, you are at 5% utilization. Your score is elite. How do you get high limits? You ask. Every 6 months, you should be asking your credit card issuers for a credit limit increase. Most of the time, this is a soft pull. It does not hurt your score. You just ask. If you have been paying on time and your income supports it, they will give you more room. You are padding your utilization buffer. Let's pivot to the rewards. This is where we talk about getting paid to exist. Banks charge merchants, the stores you shop at, a fee every time you swipe. It is called an interchange fee, usually around 2 to 3%. The bank wants you to use their card so they can collect that fee. To incentivize you, they share a piece of that action with you in the form of points or cash back. If you are using a debit card, the merchant still pays a fee, but the bank keeps it all. You are subsidizing the system and getting nothing. There are two main strategies here: cash back and travel points. Cash back is simple. You get 2% back. It is liquid, it is easy. If you are just starting, get a flat 2% card. But the real value, the insider value, is in transferable points. This is the ecosystem of American Express, Chase, Citi, and Capital One. These points are flexible currencies. 1 point is usually valued at 1 cent if you redeem it for cash. But if you transfer that point to an airline partner, it can be worth 2, 3, 4, even 10 cents. Here is a concrete example. A business class flight to Europe might cost $4,000 cash, or it might cost 80,000 miles. If you used a cash back card, you would need to spend $200,000 to earn $4,000 in cash back to buy that ticket. But if you use a points card and understand the transfer game, you might only need to spend $40,000 or $50,000 to earn the 80,000 points, thanks to sign-up bonuses and category multipliers. You are getting the same product for a fraction of the spending. That is arbitrage. That is using the system's inefficiencies against itself. Now let's move to the masterclass Business Credit. If you are a freelancer, a side hustler, or you sell things online, you have a business. You can apply for business credit cards. Why does this matter? Because most business credit cards do not report to your personal credit report unless you default. This is massive. Remember utilization? Let's say you need to buy $10,000 of inventory or equipment for your business. If you put that on your personal card, your utilization spikes and your personal credit score crashes right when you might need it for a mortgage. If you put that on a business card, your personal credit score does not move. The utilization is hidden. You can max out a business card, though I don't recommend it without a plan, and your personal FICO remains an 800. This leads us to the concept of capital access and leverage. The difference between a consumer and an investor is how they view the word debt. Consumer debt is buying liabilities. Clothes, dinners, gadgets that lose value. Paying interest on this is financial suicide. Interest rates on credit cards are 20 to 25%. This is wealth destruction. Never, ever pay interest on consumer purchases. Leverage is different. Leverage is using debt to buy assets or to bridge cash flow. Let's say you have a business opportunity. You can buy inventory at a discount for $10,000 and sell it for $15,000 within 3 months. You do not have the cash. You can use a credit card with a 0% APR introductory offer. Many cards offer 0% interest for 12 to 18 months. You swipe the card, you buy the inventory, you pay 0 interest, you sell the inventory, you pay back the $10,000, you keep the $5,000 profit. You just used the bank's money to make $5,000. That is infinite return on your own capital, because you used none of your own money. That is leverage. This applies to real estate as well. An 800 credit score gets you the best rates. On a $500,000 mortgage, the difference of 1% in interest rate is equivalent to tens of thousands of dollars over the life of the loan. Your credit score is the single most profitable asset you can build. It pays you dividends in the form of saved interest every single day. But there are traps. The banks are not charities. They are casinos. They are betting that you will slip up. They are betting that you will see that $10,000 limit and think you have $10,000 to spend. You do not. The moment you carry a balance and pay interest, the math breaks. The rewards, that 2% cash back, are instantly wiped out by the 20% interest. You are mathematically losing. This is why the debit card lovers are so vocal. They know they lack the discipline, so they avoid the tool. That is fine for them, but if you want to operate at a higher level, you need the tool. You just need to respect it. Here is the tactical roadmap to building that perfect profile. Step 1. Check your reports. Go to the official bureaus. Look for errors. If there is a late payment that is incorrect, dispute it. If there is a collection that is not yours, fight it. Clean the slate. Step 2. If you have no credit, get a secured card. You give the bank $500, they give you a card with a $500 limit. Use it for gas, pay it off. In 6 months, it graduates to an unsecured card. Step 3. The trifecta. Build a setup of 3 cards. Card A. A catch-all card, something that gives you 2% on everything. Card B, a category card, something that gives you 3 or 4% on your highest spend, usually dining or groceries. Card C, a travel or perk card, something that gives you lounge access or specific airline benefits if you travel. Step 4. Automate. Set every card to auto-pay the full statement balance. Link it to your primary checking account. Step 5. Request increases. Every 6 months, ask for higher limits. Step 6. Monitor. Use a free app to track your score. Watch for sudden drops. Step 7. Business cards. Once you have a side income, open a business card to separate your liability and hide your utilization. I want to address a common myth. I don't need credit. I pay cash for everything. That sounds noble, but try renting a car without a credit card. They will put a massive hold on your debit card. Try checking into a luxury hotel. They will lock up your liquid cash. Try buying a house. If you have no credit score, manual underwriting is a nightmare. And beyond the hassle, you are defenseless. Cash is anonymous. Debit is vulnerable. Credit is insulated. We live in a financial system that is designed to extract wealth from the uninformed and transfer it to the informed. The uninformed pay late fees. They pay interest. They pay debit card overdraft fees. They fund the rewards program for the people on the other side. I want you to be on the other side. When I travel, I see people sitting in the terminal eating a $12 sandwich they paid for with a debit card. I am sitting in the lounge, eating free food, drinking free coffee, waiting for a flight I paid for with points, funded by the bank's marketing budget. We are both spending money, but we are playing different games. One final advanced tactic for the high rollers: the velocity of money. If you have expenses of $10,000 a month, you can pay them immediately from your checking account, or you can put them on a card. That $10,000 sits in your checking account for an extra 30 days until the bill is due. If you move that cash into a high-yield savings account or a money market fund earning 5% APY, that money is working for you for those 30 days. It is not much, maybe $40 a month, but over a year, that is $500. Plus the credit card rewards, maybe another $2,000. By simply changing the timing of your payment and the vehicle of your payment, you have created $2,500 out of thin air. That is how the rich think. They do not let money sit dead. They do not let money leave their hands until it absolutely has to. They arbitrage time. They arbitrage rates. So, here is your homework. Open your wallet. Look at your debit card. Acknowledge that it is a security risk and a missed opportunity. Log into your banking app. Set up a credit card payment for tomorrow to zero out your balance before the statement cuts. Check your utilization. Ask for a limit increase. Stop playing the game with one hand tied behind your back. The system offers you tools. It offers you protection. It offers you leverage. But it demands discipline. If you can master your psychology, the credit card is the greatest financial tool available to the consumer. If you cannot master your psychology, it is a chainsaw. Choose to be the operator, not the victim. Start building that 800 score today. Because when the opportunity of a lifetime shows up, that distressed property, that business deal, it will require capital. And your credit score is your resume for that capital. Do not let fear of debt keep you from the power of leverage. Understand the difference, respect the math, and stop using debit.